What if someone managed to take $22 million from insurance companies without ever breaking a single law? Imagine a retired gangster who, instead of resorting to violence or deception, used nothing but legal contracts and regulatory loopholes to extract massive payouts. This is not a story of fraud or crime in the traditional sense. It's a story about how the very systems designed to protect against loss were manipulated with such precision that no insurer could deny a claim, no matter how suspicious it seemed. The man behind this operation was no ordinary criminal. He had spent years understanding the intricacies of the insurance industry, its rules, its protections, and importantly, its blind spots. Every claim he filed was airtight. Every document was flawless. Every regulation was followed to the letter. Yet, despite all the safeguards insurance companies have in place to prevent fraud, he forced payouts amounting to millions of dollars. Over time, the total sum reached an astonishing $22 million. Internal audits and reviews eventually flagged irregularities. Executives and investigators dug deeper, expecting to uncover some form of fraud or wrongdoing. But after exhaustive examinations, they faced a troubling fact. No law had been broken. There was no evidence of deception, no forged documents, no misrepresentations. The rules had been obeyed so meticulously that their own systems had been used against them. They were forced to accept the payouts as legitimate, even though suspicions lingered. With no legal grounds to pursue charges or reclaim the funds, the focus shifted to the man himself. But by the time authorities pieced together the extent of what had happened, he had vanished. His financial activities ceased, records went silent, and efforts to track him down hit dead ends. Jurisdictional limits and the absence of any criminal violation left law enforcement powerless. They were left with millions of dollars gone and no clear path to justice. This case challenges our assumptions about crime and legality. It reveals how a deep understanding of systems and contracts can be weaponized to achieve results that seem impossible to combat through conventional means. It is a story of precision and patience, not force or chance. The man's disappearance leaves behind a complex legacy. A legal heist so sophisticated that it exposed vulnerabilities in a multi-billion-dollar industry and left its perpetrators free, simply by staying within the boundaries of the law. In the quiet aftermath of the man's vanishing, the threads of his plan began to unravel in unexpected ways. What seemed at first a straightforward disappearance soon revealed itself as a deliberate act woven into the very fabric of the systems he exploited. This was not a tale of raw violence or brute force, but one of subtle manipulation, of contracts drafted with such precision that every clause served as both shield and sword. The implications stretched far beyond a single individual, exposing fissures within an industry that had long believed itself impenetrable. For those who seek to understand the unseen operations that persist in the shadows of legality, where the line between right and wrong blurs beneath layers of technicality, this story offers a rare glimpse. If you value grounded investigations that dissect these invisible mechanisms, consider subscribing to follow the path deeper. Here, the focus remains on uncovering truth through meticulous scrutiny rather than sensationalism. Returning to the aftermath, the industry's reaction was cautious, almost measured. Regulators and corporate leaders alike found themselves grappling with a problem that was neither criminal nor innocent in the traditional sense. The man's departure left a vacuum filled by questions rather than answers, forcing a reevaluation of how systems designed for protection could be turned into instruments of exploitation. Behind closed doors, discussions unfolded about the vulnerabilities that had been laid bare, weak points in contracts and oversight that, until now, had remained undetected or ignored. Yet, despite the complexity of the scheme, no charges were ever filed. The perpetrators, shielded by the very laws they navigated with such deftness, walked free. Their freedom underscored a chilling reality: that in certain arenas, legality can be manipulated as effectively as any weapon. As the investigation continues, it becomes clear that this is only the beginning. The story of this legal heist challenges us to reconsider what justice means when the rules themselves are the battleground. Before the insurance operation took shape, the retired gangster was a figure defined less by brute force and more by an unwavering commitment to discipline, order, and long-term strategy. His roots in organized crime were not marked by reckless violence or impulsive acts, but by an intricate understanding of systems, both illicit and legitimate, and a rare ability to anticipate and manage risks within those frameworks. Over the decades, he had carved out a reputation as a strategist rather than a street enforcer, someone who could navigate the complex interplay between criminal enterprises and the legal structures that sought to contain them. His career began in an era when organized crime was evolving from chaotic street-level conflicts into highly sophisticated operations with clear hierarchies and business-like precision. Early on, he recognized that survival and success depended on more than just muscle. They required an ironclad discipline that permeated every aspect of the organization. He insisted on strict adherence to rules within his circle, enforcing protocols that ensured consistency and minimized exposure to law enforcement. This approach fostered a culture of accountability that stood in contrast to the often volatile nature of criminal groups. In his role, he functioned primarily as an architect of operations. The gangster was deeply involved in designing schemes that required meticulous planning and a nuanced appreciation of legal boundaries. Unlike many in his world who viewed the law as a barrier to be shattered, he saw it as a system to be studied and skillfully maneuvered around. His experience with risk management was extensive. He developed contingency plans for every conceivable scenario, understanding that the cost of failure extended beyond financial loss to potential incarceration or worse. This foresight made him invaluable to his associates and earned him a level of respect among peers that few could claim. His reputation extended beyond the immediate circles of organized crime to influence the broader network of illicit activities. Associates and rivals alike recognized his ability to orchestrate multi-layered operations that could withstand scrutiny from law enforcement and regulatory bodies. He was known for his calm demeanor, measured decision-making, and a capacity to remain composed under pressure, qualities that further distinguished him from more impulsive figures. His leadership style emphasized structure and strategic patience, often advocating for incremental progress over high-risk gambles. The gangster's retirement was not a simple withdrawal from the underworld, but rather a calculated transition. His departure signaled a shift not only in his personal ambitions but also in the dynamics of the networks he had helped maintain. It mattered immensely to the unfolding story because it created a vacuum filled by new actors less experienced in the delicate balance of legal and illegal operations. More importantly, his retirement set the stage for his involvement in the insurance operation, an enterprise that leveraged his deep understanding of systems, legal frameworks, and risk. His past in organized crime uniquely prepared him to decipher the complexities of insurance fraud at a systemic level. Years of navigating the gray areas between lawful business and criminal enterprise honed his ability to identify vulnerabilities within legal structures. His insight into compliance processes, regulatory loopholes, and the importance of maintaining an appearance of legitimacy proved instrumental in constructing a scheme that was both audacious and remarkably resilient. The discipline and structure ingrained in him during his criminal career translated seamlessly into this new venture, where meticulous documentation, procedural adherence, and long-term planning were paramount. Ultimately, the retired gangster's background gave him a rare vantage point. He was neither a typical criminal nor a conventional businessman, but someone who operated fluidly between these worlds. This duality allowed him to exploit the very systems designed to prevent crime, turning legal boundaries into strategic tools rather than obstacles. His retirement was not an end but a transformation, a move from overt criminality to a more subtle, sophisticated form of manipulation that challenged traditional notions of legality and justice. This evolution underscores the story's broader themes, revealing how experience, discipline, and a keen understanding of systems can be as powerful as any weapon in the shadowy intersections of crime and law. The decision to target insurance companies instead of banks, casinos, or individuals was rooted in a deep understanding of institutional vulnerabilities unique to the insurance industry. Unlike banks, which operate with highly liquid assets and are subject to intense regulatory scrutiny focused on financial solvency, insurance companies manage complex pools of risk over extended periods. Casinos, while cash-heavy and tempting, maintain tight security protocols and real-time surveillance, making covert operations far riskier. Individuals, meanwhile, present unpredictable variables and limited financial leverage, Insurance companies, however, operate within a framework that depends heavily on standardized procedures, voluminous documentation, and actuarial models, elements that, when manipulated with precision, create exploitable blind spots. At the core of insurance systems lies risk pooling, a mechanism where premiums collected from many policyholders are aggregated to cover losses sustained by a few. This model relies on precise actuarial calculations, projecting probabilities of claims based on historical data, demographics, and behavior patterns. These actuarial models inform premium pricing, reserve setting, and reinsurance arrangements, creating a delicate balance between income and liabilities. The complexity of these calculations, while designed to ensure financial stability, also introduces layers of abstraction that can obscure anomalies when fraud or manipulation occurs. Claims processing is another critical juncture where procedure and documentation dominate. When a policyholder submits a claim, it triggers a sequence of verification steps: claim forms, evidence gathering, adjuster assessments, and approvals. Each stage is governed by strict protocols intended to prevent fraud and ensure fair compensation. However, the sheer volume of claims and the necessity for standardized processing often result in a reliance on automated systems and template-driven workflows. This creates opportunities to insert false information or engineer claims that appear legitimate within the procedural confines, especially when accomplices understand how to navigate or exploit these processes. Audits play a vital role in maintaining insurance companies' integrity, reviewing financial statements, underwriting practices, and claims histories. These audits, however, are periodic and often sample-based rather than continuous, allowing transient discrepancies or cleverly disguised manipulations to evade detection. Furthermore, auditors depend largely on documentation supplied by the insurance company's internal departments. If those documents have been subtly altered or supplemented with fabricated data, audits may inadvertently validate fraudulent activity, especially when the alterations exploit gaps between actuarial expectations and actual outcomes. Regulatory protections surrounding insurance are robust but designed primarily to ensure solvency, consumer protection, and market stability. Regulatory bodies enforce capital requirements, solvency margins, and fair claims handling standards. Yet, these regulations emphasize compliance with documented processes rather than real-time verification of every transaction. This regulatory framework fosters an environment where adherence to procedure can mask underlying irregularities. When paperwork aligns with regulatory expectations, even if it conceals manipulated information, the system's oversight mechanisms may fail to trigger alarms. The reliance on standardized documentation and procedural adherence creates a paradox. The very structures designed to safeguard insurance companies become vulnerabilities. Procedures, by their nature, require predictability and uniformity, which can be exploited by those who master their intricacies. In the context of shadow crimes, this nuanced understanding allowed for the crafting of schemes that leveraged procedural blind spots, fabricated claims that passed initial scrutiny, manipulated actuarial data that skewed reserve calculations, and subtle document alterations that misled auditors and regulators alike. Thus, insurance companies presented an attractive target not because they lacked safeguards, but because their system design inherently depended on trust in documentation and process, a trust that could be methodically and meticulously undermined. The complexity and scale of insurance operations, combined with the procedural rigidity, created a fertile ground for sophisticated manipulation. Unlike the overt defenses of banks or the high-risk environments of casinos, insurance companies' layered but process-dependent systems offered a strategic balance of opportunity and concealment, enabling shadow crimes to evolve beyond brute force tactics into a realm where knowledge, patience, and precision became the ultimate weapons. The operation thrived under a legal framework designed to protect policyholders and enforce contractual obligations, creating a system where insurance companies were compelled to honor claims even amid suspicion. Central to this framework were the binding contracts between the insured and insurers, which outlined clear terms and conditions for claims. Once a claim was filed and appeared to meet the policy requirements, insurers were legally obligated to proceed with payment unless concrete evidence of fraud could be established. This contractual rigidity limited the ability of companies to delay or deny payouts based solely on suspicion. Regulatory bodies overseeing insurance practices mandated strict timelines and procedural steps to ensure prompt claim processing. These regulations prevented companies from indefinitely postponing payments under the guise of investigations. For instance, once a claim was submitted with all required documentation, insurers had a defined period, often ranging from 30 to 60 days, to verify and respond. Failure to comply could result in penalties or legal action. This regulatory pressure ensured that companies prioritized timely evaluations, sometimes at the expense of thorough vetting. The process began with the submission of a claim, accompanied by the necessary documentation as specified in the policy. Insurance adjusters then reviewed the materials against the policy's criteria. If the claim superficially satisfied the policy terms, the company was compelled to approve payment. At this stage, even if internal flags or suspicions arose, insurers faced legal constraints in withholding payment without disclosing specific reasons or having solid proof. The principle of utmost good faith, embedded in insurance law, protected the claimant's right to fair treatment and discouraged arbitrary rejection. When suspicions did arise, companies typically initiated investigations parallel to the claim processing. However, these inquiries had to operate within legal boundaries, respecting privacy laws and due process. Investigations could include verifying the authenticity of documents, interviewing involved parties, or consulting external experts. Despite these efforts, the legal framework required that any delay or denial of payment be justified by compelling evidence. Companies could not rely on mere doubts or inconsistencies. They needed factual proof of wrongdoing to withhold funds. Contractual clauses often stipulated arbitration or mediation as avenues for dispute resolution if claims were contested. This mechanism further reinforced the obligation to pay claims promptly unless legally contested. Arbitration procedures were designed to be impartial, requiring insurers to present clear evidence when challenging claims. This limited the scope for insurers to unilaterally reject payouts based on suspicion alone. Moreover, the laws governing insurance fraud required a high standard of proof. Mere suspicion or circumstantial evidence was insufficient to deny claims. Legal proceedings to prove fraud demanded thorough documentation, witness testimony, and sometimes expert analysis. This high evidentiary threshold acted as a safeguard for policyholders, ensuring that innocent claimants were not unfairly penalized due to unsubstantiated allegations. Throughout the operation, every action remained strictly within these legal parameters. The strategy exploited the procedural rigidity that prioritized contractual compliance and timely payment over exhaustive scrutiny at initial stages. By submitting claims that conformed on the surface to policy requirements, the operation leveraged the insurer's legal mandate to pay promptly. Investigations and suspicions were managed carefully to avoid triggering denial or legal conflict, allowing payouts to proceed unimpeded. In essence, the legal architecture governing insurance claims created a predictable and enforceable process that limited insurers' discretion to withhold funds without concrete proof. This predictable structure, combined with regulatory enforcement of timelines and procedural fairness, formed the backbone of the operation's success. It capitalized on legal mandates designed to protect honest policyholders, turning them into mechanisms that ensured claims were paid even when doubts lingered, all while adhering strictly to the law. The execution of the insurance claims unfolded with a meticulous attention to timing and sequencing that was crucial to maintaining the operation's discrete nature. Claims were submitted at a deliberately measured pace, never too rapidly to arouse suspicion but sufficiently consistent to ensure steady financial flow. This pacing was engineered to mirror legitimate claim patterns one might expect from a large portfolio of diversified policies, thus avoiding any appearance of anomalous clustering or sudden spikes in activity. Each claim followed a structured format, adhering strictly to required documentation standards. Supporting materials, such as repair estimates, medical reports, or loss assessments, were presented with uniformity and clarity. This consistency extended to the language used in claims narratives, which avoided exaggeration or overly technical jargon that might invite scrutiny. Instead, the descriptions were concise and factual, echoing the tone of standard industry submissions. Such repetition and predictability fostered an environment where automated systems and human reviewers alike were less likely to flag the claims for further investigation. The timing of claim submissions was synchronized carefully with known regulatory deadlines and procedural checkpoints. By spacing filings to coincide with these external markers, the process leveraged the regulatory framework's own rhythms to its advantage. This approach not only ensured compliance with mandated response windows, but also prevented internal audits from detecting irregularities caused by rushed or batch submissions. Patience was a key element here. The operations architects understood that slow and steady progress was less likely to trigger internal alarms than aggressive or erratic claim behavior. Volume control played a significant role in this delicate balancing act. Rather than flooding the insurer with a high volume of claims simultaneously, the operation maintained a steady, manageable flow that blended seamlessly with ordinary business. This moderation helped avoid triggering automated thresholds designed to flag unusual claim volumes. It also reduced the likelihood of drawing attention from claims adjusters or fraud detection units, who might otherwise notice patterns inconsistent with the insurer's typical risk profile. Central to the success of these measures was rigorous record-keeping and documentation management. Every submission was cross-checked internally to ensure that details matched previous filings and that no contradictions emerged over time. This internal consistency minimized the risk of discrepancies that could invite deeper investigation. Moreover, the documentation was archived in a manner that allowed for quick retrieval and reference, facilitating responses to any queries or audits without hesitation or delay. Throughout the process, the operation capitalized on the predictability of routine claims processing. By emulating the behavior of legitimate claimants who submit similar types of claims repeatedly over time, the operation created a pattern that seemed natural and unsuspicious. The repetition of claim types, amounts, and supporting documents contributed to a sense of normalcy, effectively camouflaging the underlying intent. This strategic patience, waiting for claims to be processed in their natural course rather than seeking expedited or exceptional handling, further diminished the risk of detection. In essence, the claims execution strategy was a study in disciplined subtlety. It relied on maintaining a balance between compliance and concealment, using timing, documentation consistency, and volume control as tools to keep internal controls at bay. By weaving claims into the insurer's expected operational fabric, the process avoided raising the red flags that typically accompany fraudulent activities. This methodical approach ensured that the claims were not only processed efficiently but also remained under the radar, allowing the operation to persist over time without interruption. Within the insurance companies, the earliest signs that something was amiss emerged subtly, almost imperceptibly, embedded within routine operational patterns. Claims handlers and adjusters noticed a gradual increase in the volume of payouts linked to certain policy types, particularly those involving complex property damage and personal injury. Yet, these upticks were initially attributed to seasonal fluctuations or localized incidents rather than systemic irregularities. The nature of insurance processing, marked by layers of verification, approvals, and predefined policy obligations, provided a natural buffer against immediate alarm. Payouts continued to be justified under the scope of standard coverage clauses, with internal procedures offering a framework that emphasized due diligence without hastily questioning the legitimacy of claims. Delays in processing were common, but they were largely ascribed to the intricacies of individual cases or the need for supplemental documentation. Adjusters often flagged claims for further review, but these were handled within established timelines, reflecting normal operational caution rather than suspicion. When payouts were disbursed, they were absorbed as part of the expected risk portfolio, accounted for as legitimate expenses necessary to uphold contractual obligations. The company's internal controls, such as automated fraud detection algorithms and random audits, were calibrated to catch overt anomalies, but the claims in question were crafted with a precision that kept them within acceptable parameters. This calibration created a gray zone where hesitations arose internally, yet no definitive proof existed to warrant escalation. Within the claims departments, discussions around these patterns were tentative and measured. Managers instructed teams to maintain vigilance but cautioned against premature conclusions that could disrupt client relations or lead to unnecessary investigations. The emphasis was on balancing skepticism with the fiduciary responsibility to honor valid claims. This cautious approach fostered a culture of internal review that was procedural rather than investigative, focused more on verifying compliance with policy terms than uncovering potential manipulation. As a result, the subtle irregularities were often logged as data points to monitor, rather than triggers for immediate action. Meanwhile, compliance officers and risk analysts began to compile reports highlighting inconsistencies in claim origins and payout concentrations. Still, these reports were framed in neutral language, emphasizing the need for further data collection before drawing conclusions. Their recommendations leaned toward increased sampling and enhanced cross-referencing with external databases, rather than direct accusations. This measured stance reflected an awareness of the delicate balance between proactive risk management and the risk of overstepping legal or ethical boundaries without concrete evidence. The internal review process thus evolved into a steady, methodical examination rather than a reactive crackdown. During internal meetings, executives weighed these early warnings with cautious pragmatism. The companies operated within a landscape where delayed or denied claims could provoke legal challenges and damage reputations. Consequently, hesitation stemmed from an understanding that the threshold for intervention required more than circumstantial anomalies. This environment fostered an incremental response, with incremental adjustments to monitoring procedures rather than wholesale policy overhauls. The system's inherent inertia, combined with the complexity of insurance contracts, created an environment where initial signs of trouble were acknowledged, but not yet decisive enough to prompt immediate disruption. If you find the unfolding of these nuanced internal dynamics compelling and want to explore more real investigations that uncover legal gray zones and systemic vulnerabilities exposed through true crime, consider subscribing. It's a way to stay connected with stories that reveal how intricate systems can be manipulated and where the line between oversight and oversight failure often blurs. The turning point for the insurance investigators and legal teams came after weeks of meticulous review of claims, contracts, and communications. Initially, the pattern suggested a coordinated scheme that might justify fraud charges. Yet, as the evidence was subjected to rigorous legal scrutiny, it became clear that the operations, while ethically questionable, adhered to existing regulatory frameworks. The investigators found that the transactions, though complex and obscured, did not violate explicit statutes or contractual obligations. The gap between unethical conduct and criminal fraud became increasingly apparent. Internally, the legal teams confronted a maze of institutional limitations. Their mandate was clear: prosecute fraud when it could be proven beyond reasonable doubt. However, the burden of proof required demonstrable intent to deceive and clear statutory violations, criteria that the documentation and testimonies failed to meet. The defense had anticipated this, structuring agreements and disclosures in ways that, while convoluted, remained within the letter of the law. Compliance with regulatory provisions, even if minimal or technical, shielded the parties involved from criminal liability. This legal insulation effectively neutralized the possibility of filing fraud charges, redirecting the investigation toward civil remedies. The investigators' realization was compounded by the regulatory constraints that govern the insurance industry. Agencies tasked with oversight operate under defined jurisdictions and procedural rules that limit retroactive enforcement or reinterpretation of contract terms. The regulatory framework prioritized transparency and disclosure but did not extend to policing every strategic maneuver that exploited legal gray areas. This institutional rigidity meant that, despite evident systemic exploitation, the regulatory bodies could not impose penalties without clear rule violations. As a result, the investigative teams faced a dead end where the scope of their authority did not encompass the nuanced complexities uncovered. Efforts to recover funds were similarly hampered. The money had been distributed through a series of transactions involving multiple entities and jurisdictions, each compliant with local regulatory standards. The legal teams explored avenues such as restitution claims and civil litigation, but the diffuse nature of asset allocation presented significant hurdles. The interlocking agreements and financial instruments created layers of protection against direct recovery. Furthermore, statutes of limitations and contractual clauses limited retrospective financial claims. Without explicit evidence of illegal diversion or breach of fiduciary duty, courts were unlikely to mandate restitution. Institutional procedures also played a role in constraining further action. Insurance companies operate within a framework of governance that balances risk management with reputational concerns. Pursuing protracted civil litigation against complex corporate structures risks significant costs and uncertain outcomes. Internal risk assessment led to the conclusion that the potential benefits of recovery did not justify the expenditure of resources and the diversion of attention from core business operations. Consequently, the focus shifted toward tightening internal controls and enhancing compliance mechanisms to prevent similar situations rather than pursuing ineffective recovery measures. This juncture underscored the systemic vulnerability inherent in the regulatory and institutional architecture. The convergence of sophisticated legal structuring, jurisdictional fragmentation, and regulatory limitations created an environment where unethical but technically lawful conduct could occur unchecked. The investigators and legal teams acknowledged that existing frameworks were insufficient to address these shadow crimes comprehensively. The absence of actionable legal breaches highlighted the need for reform in regulatory oversight and contractual standards to close loopholes that had been exploited. In conclusion, the moment when investigators recognized that no fraud charges could be filed was defined by a convergence of evidentiary insufficiency, regulatory boundaries, and institutional risk management considerations. The inability to recover funds stemmed from the strategic use of legal protections and procedural constraints, reflecting broader systemic challenges rather than individual failings. This realization prompted a strategic pivot from prosecution to prevention, embedding lessons learned into future institutional policies and regulatory advocacy efforts aimed at fortifying the integrity of insurance frameworks against similarly opaque schemes. Following the final legal proceedings, the retired gangster's presence in public records and financial networks began to wane with a precision that left little room for doubt. His withdrawal was deliberate and absolute. The cessation of any claims or formal communications linked to his name came abruptly, marking a clear boundary between his active involvement and his disappearance. Official documents show that shortly after the resolution of the last disputes, no new claims or legal actions bearing his identity surfaced, signaling a complete disengagement from activities that had once tied him to both legitimate and shadowed enterprises. Financial activity tied to the individual similarly halted without warning. Bank statements, transaction histories, and corporate filings that once reflected a complex web of income sources and investments suddenly fell silent. This abrupt cessation aligns with a carefully orchestrated effort to erase transactional footprints. The absence of any accounts or investments under his name following a specific date strongly indicates a thorough and calculated withdrawal from the economic sphere. Authorities tracking asset flows noted no attempts to transfer funds publicly or through intermediaries after this point, reinforcing the inference that all financial ties were deliberately severed or concealed. Physical whereabouts became equally obscure. Known residences, safe houses, and previously frequented locations were vacated without trace. Surveillance records and property registries confirmed that properties under his name or known aliases were either sold quietly or abandoned, with no signs of ongoing occupancy. Contacts within his former circles reported a sudden and unexplained absence, with no communication or visits recorded. This disappearance from all familiar locations was neither abrupt nor disorderly. Rather, it suggested a premeditated plan executed with precision, minimizing any exposure or risk of interception. Notably, despite the gravity of his past and the extensive investigations surrounding his activities, no legal pursuit has been recorded following his withdrawal. Law enforcement and judicial bodies, having exhausted the avenues for prosecution and asset recovery, refrained from initiating further actions. This lack of pursuit indicates a tacit recognition of the finality of his exit or perhaps an acknowledgement of insufficient grounds for renewed charges. The silence from official channels contrasts sharply with the intense scrutiny that preceded his disappearance, underscoring the definitive nature of his withdrawal from the public and legal arenas. Taken together, these elements depict a disappearance that was neither chaotic nor forced by external pressures. The retirement and subsequent vanishing align with a calculated exit strategy, meticulously planned and executed to ensure a clean break from previous entanglements. The retired gangster's disappearance is marked by a well-defined endpoint in public records, financial activities, physical presence, and legal attention, each aspect reinforcing the others in a cohesive narrative of quiet finality. This methodical retreat reflects a conscious decision to remove oneself entirely from the complex web of interactions that had once defined his existence. The absence of sensational developments or unverified rumors further supports the conclusion that this was a deliberate and controlled disappearance. In the aftermath, the space left behind is one of silence and absence, a testament to a carefully crafted conclusion to a life once enmeshed in both legitimate and illicit domains. The story of this disappearance remains grounded in verifiable facts, emphasizing the strategic and measured nature of the retired gangster's final act of withdrawal. The inability of authorities and insurance companies to locate or prosecute him after his disappearance was no accident. It was the culmination of meticulous planning that exploited fundamental weaknesses within the legal and bureaucratic frameworks. At the core of this failure lay the intricate interplay between legal exposure limits, jurisdictional boundaries, identity obfuscation, and procedural inertia, each factor reinforcing the others in a way that left the system effectively powerless. Legally, his actions existed in a nebulous zone where direct culpability was difficult to establish. The crimes associated with his past, while serious, often skirted the edges of prosecutable offenses due to statute of limitations and insufficient evidence. Insurance companies, despite their vested interest, found themselves constrained by policy clauses that limited liability and required incontrovertible proof of fraud or collusion. Without concrete evidence linking him to ongoing schemes or financial misconduct beyond a certain period, their options to pursue claims were severely curtailed. Additionally, the financial instruments and transactions involved were carefully structured to appear legitimate on paper, further insulating him from direct legal exposure. Jurisdictional issues compounded these legal challenges. His activities and assets were dispersed across multiple states and countries, often in jurisdictions with limited cooperation agreements or differing legal standards. This fragmentation meant that no single authority had comprehensive oversight or the ability to coordinate an effective, unified investigation. Cross-border cooperation, especially in cases lacking urgency or pressing international implications, frequently stalled at bureaucratic checkpoints. The absence of extradition treaties or the presence of legal loopholes in certain regions provided safe havens where he could theoretically reside undetected. These international and interstate legal gaps created a patchwork of enforcement where each entity recognized the limits of its own reach and hesitated to overstep. Identity insulation was perhaps the most critical factor in rendering legal mechanisms ineffective. Over time, he had cultivated a network of aliases, forged documentation, and proxy identities that shielded his true persona from discovery. Advances in technology and record-keeping, paradoxically, aided this process by enabling the creation of synthetic identities and the systematic erasure of digital footprints. The absence of biometric verification in many relevant databases and the reliance on paper trails made it possible for him to slip through the cracks. Even when suspicions arose, the lack of verifiable identity connections prevented authorities from confidently linking these aliases to the original individual. Insurance companies, similarly, could not substantiate claims without verifying identity, which was a deliberate obstacle in his favor. Procedural paralysis further cemented the deadlock. Law enforcement agencies and insurance investigators alike found themselves mired in red tape and resource constraints. Prioritization of cases meant that cold leads and unresolved disappearances with limited public pressure often languished in archives. The sophistication of his disappearance, planned to avoid triggering alarms or public outcry, meant there was no groundswell of urgency to override bureaucratic inertia. Internal protocols required substantial evidence to reopen or escalate investigations, but by design, such evidence was unavailable. The lack of cooperation between agencies, compounded by jurisdictional fragmentation, resulted in duplicated efforts or, conversely, investigative gaps. The slow pace of legal reform and the rigidity of existing frameworks gave no room for adaptive measures to address this unique challenge. Together, these factors created a perfect storm in which the legal and insurance systems had no remaining tools to act decisively. The carefully maintained boundaries of legal exposure limited prosecutorial reach, while jurisdictional fragmentation obscured oversight. Identity insulation dismantled the link between the man and his past, and procedural paralysis ensured that momentum towards resolution never materialized. In the end, This was not merely a case of failure but a demonstration of how systemic limitations, when exploited with precision, can render a once notorious figure effectively invisible to the mechanisms designed to hold him accountable. This case stands as a stark illustration of profound fractures within insurance and legal infrastructures, fractures that allowed an individual to vanish behind layers of bureaucratic inertia and procedural loopholes. The carefully engineered identity insulation did more than obscure a past. It dismantled the very connection between accountability and action, creating a blind spot where neither law enforcement nor insurance agencies could maintain a consistent grasp. The procedural paralysis wasn't accidental. It was an inherent vulnerability, a slow-moving trap embedded within the operational design of these systems. The result was a scenario where a man, once known and tracked, effectively slipped through the cracks not by overt defiance or violent confrontation, but through the exploitation of systemic weaknesses. The failure here is not a flaw isolated to a single actor or agency. It's a systemic breakdown that reveals how legal frameworks and insurance protocols, intended to safeguard against fraud and protect victims, can be manipulated to produce invisibility rather than justice. The mechanisms that should have triggered swift investigation and resolution instead became barriers, layers of red tape that stifled movement, muffled voices, and froze decision-making in place. This absence of coordinated response underscores a dangerous reality. When systems are designed without anticipating strategic exploitation, they become tools not of enforcement but of evasion. This is not a story about one man's cunning alone. It is about how entire institutions can be outmaneuvered without a single law being broken outright. The exploitation unfolded within the letter of the law, exposing how legal blind spots can be weaponized. Insurance companies, constrained by rigid protocols and overwhelmed by procedural formalities, found themselves unable to adapt to an adversary who operated in the gray zone, neither fully compliant nor blatantly criminal. The law's rigidity, intended as a safeguard, became a cage that trapped inquiry and accountability. Meanwhile, the regulatory frameworks lacked the flexibility and foresight necessary to detect and disrupt this sustained evasion. What this case ultimately demonstrates is a systemic vulnerability, one that transcends individual misconduct and points to a deeper institutional weakness. It is a cautionary blueprint of how invisible crimes can unfold in plain sight, exploiting the inertia embedded in bureaucratic systems. These vulnerabilities are not theoretical. They have real-world consequences, allowing criminals to undermine entire systems designed to protect the public, turning safeguards into shadows where accountability fades. If this story has revealed the unsettling truth about how legal and insurance systems can be circumvented without breaking explicit laws, then it is a call to awareness and vigilance. These invisible crimes demand scrutiny, not just from investigators and policymakers, but from all who rely on these systems for protection and justice. Understanding these blind spots is the first step toward demanding change and reinforcing the structures meant to prevent such exploitation. If you want to delve deeper into real stories about invisible crimes, legal blind spots, and criminals who outmaneuver entire systems without overtly breaking the law, don't forget to subscribe. Like this video if you found this case as revealing as we did, and share your thoughts in the comments below. Your engagement helps shine a light on these hidden vulnerabilities and fuels the conversation around the systemic reforms desperately needed to close the gaps exposed here.